Hi, it's Jim Turner, CPA and certified valuation analyst, the Biz Val guy. I help buyers and sellers understand what a business is actually worth. Today, I'm going to talk about why small businesses get overvalued, the SDE trap, or seller discretionary earnings. If you're buying or selling a business between $1 and $25 million, this video could help save you hundreds of thousands of dollars because one of the most common ways businesses are priced today can quietly overvalue a business. And today, I want to explain why relying only on something called SDE can lead to bad deals. Let's start with what you see in the market. You'll often see listings that say this business earns $300,000 SDE and is priced at 3 times SDE. So the asking price is $900,000. Seems simple, but here's the issue. The SDE number usually includes the owner's salary. So let's say the owner works full time and pays themselves $150,000, and that's a market salary. SDE adds that market wage back. So now it looks like the business earns $300,000. But here's the real question. Who is going to run the business after you buy it? If it's you, then part of that quote profit is really just your job. It's return on your wage. If it's someone else, you have to pay them. Either way, that $300,000 is not all profit. This is where buyers get into trouble. You have to separate income for working from return on your investment. If you're putting $1 million into a deal, you should be asking, what is my return after paying someone to run the business, whether that's me or an employee? What is it going to cost me? That's the number that matters. Let me give you a simple example. A business has $500,000 in revenue. The owner pays themselves $95,000, and that's a market wage. And the actual profit is only about $10,000. Now, watch what happens. Using seller discretionary earnings, or SDE, the earnings look like $105,000. Apply a multiple of 3 times, which is common, and the value looks to be around $315,000. But based on actual profit, the value is closer to $30,000. That's a huge difference. Now think about this as a buyer. If you pay based on SDE, you might be paying for income that is partially a return on your labor, working full time just to earn a return on the acquired small business, less than a safe investment like a money market or a savings account. Definitely not as much as you could earn in the stock market. That's not a good deal. This issue even came up in a recent court case. One side valued a business at over $600,000 using SDE. The other side adjusted for a market compensation for the owner and valued it at about $73,000. The court agreed with a lower number. But why? Because someone still has to run the business. Now, if you're a seller, this matters just as much. Buyers today are getting more sophisticated, and their bankers are going to require that they look at the cash flow, the real cash flow. If your price is based only on SDE, it may not hold up during due diligence. It may lead to renegotiation or deals falling apart. The strongest deals are based on real transferable earnings. So here are the takeaways. Don't rely on SDE alone. Always ask, what is the profit after paying market wages to everyone, including the owner that's going to be replaced? Focus on return on investment, not just cash flow, and use more than one method to determine value. At the end of the day, a business is worth what it returns to an owner, not what it pays someone to work there. If you're buying or selling a business and want to understand the real value, follow this channel. I break down real world valuation issues so you don't overpay or undersell. And if you like this video, give it a thumbs up and subscribe. And in the comments below, write about a topic you would like for me to talk about. As always, it's Jim Turner, the Biz Val guy. Until next time, see you then. Bye.